The Federal Open Market Committee left interest rates unchanged today at their meeting, as largely expected. We're here to discuss the impacts on the markets with Thomas Hayes, managing member of Great Hill Capital. Thomas, welcome back.
Thanks for having me, David.
I'm just going to read you a snippet from their statement here. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. Now, they did not indicate exactly when this reduction in asset purchases would commence, so no specific timeline of tapering yet.
A gradual tapering process that concludes around the middle of next year is likely to be appropriate.
What's your initial response to the statement?
Yeah, what they're doing is setting the stage for a December announcement. And Chair Powell was asked in the press conference, what would he need to see? Because we have made substantial further progress, which is their definition on the inflation front, more than substantial. But we have not yet made it fully on the employment front. And what he deemed would be necessary for them to check the box would be an employment report that came in obviously much better than last month, which was a huge disappointment at 223,000. But something in line with expectations would be enough of a hurdle for us to get over for them to then move ahead, most likely with an announcement in November. And then the question would be, when would be implementation? Would it be immediately in November or more likely December? We happen to think it's going to be early next year. There are a lot of headwinds that they could push it off if they want to. But even assuming that they move ahead with a $15 billion a month taper in December through, let's call it July of 2022, that period is still going to be incredibly accommodative, and an incredible amount of liquidity is still going to go into the system during the taper. And just to give you an idea, David, the bond purchases, while they're reducing at $15 billion a month over that 8-month period, will be about $450 billion. And then you have another $200 billion or so of interest and principal reinvestment. So that takes you up to about $660 billion of additional liquidity during the taper period, which is actually larger than the entire sum of QE2 was, which was $600 billion. So for people thinking that the minute taper starts, the punch bowl is gone, I think that couldn't be further from the truth. That liquidity is going to still be there for some time. And then rates, he made the clear distinction that is a completely different decision-making process. And when taper is finished does not mean rate rises start right away.
That's right. Okay. So a couple points here. First of all, that was an interesting point you brought up about liquidity. Do you think that the markets realize this? Let's take a look at the market reaction today. So immediately we had a spike in risk assets. The S&P 500 went up. Gold went down. And so what we're seeing here is sort of a risk-on move. Markets are digesting this news well. Perhaps they're agreeing with you, Thomas. Perhaps they're also seeing that tapering does not equal immediate removal of liquidity in the system. Let's put it that way.
Yeah. Well, this was the first clear signal. We had some intimation during the Jackson Hole video conference, but this was the first clear signal. And this is very much like what we saw May 1st of 2013, which is our other example of taper. And what happened from their signal to implementation, so they signaled in May that they wanted to move ahead with taper, maybe as soon as June was the idea that they were talking about. They wound up punting all the way until December of 2013, so about 7 months. And during that period, the 10-year yield went from 162 basis points to 292 basis points till when they started implementing, and peaked at 3% just after, literally 12, 13 days after they started implementation. And that was the peak in rates. So it was, in terms of bonds, it was a sell the rumor, buy the news. So rates went up in anticipation of implementation once they signaled. So we just saw them signal today. And in that context, I do think you're going to see the 10-year yield rise into the end of the year and maybe towards Q1, get in the neighborhood of 175 basis points, maybe even above 2% on the 10-year yield. And in that type of environment, what we're going to see is a dramatic outperformance of value cyclicals reopening relative to tech and growth. So this summer, when yields were down, tech and growth came back. The ratio of value stock performance to growth stock performance hit a low not seen since before the election in last year. And we all know what happened after that. Value saw one of its periods of greatest outperformance relative to growth from November of last year until May of this year before rates compressed and growth came back. So now we think the tide is shifting and the value reopening is going to come back as we see rates start to creep up towards the end of the year, with taper signaled and implementation to start maybe in December, maybe early first quarter of next year.
Well, one thing that stood out to me is that more members now see or project a rate increase by next year, 2022, versus before, when the majority saw a rate increase to only happen in 2023. So just in a short amount of time, in a couple of months, sentiment kind of shifted towards liftoff sooner rather than later. Yet markets are digesting this news positively. It's going up. Can you clarify as to why that might be positive for the equities?
Yeah, well, it went to a split. So now it's 9 members don't see a rate rise in 2022 and 9 members do see a rate rise in 2022. This is kind of something separate. I think what the market was pleased to see was that taper was delayed till, earliest November, December, more likely first quarter of next year, and really setting the stage that these are two distinct actions. The earliest you're going to see a rate rise would be the end of 2022 and more likely into 2023. And the reason you saw that split come about is because while they did take their GDP estimates down for 2022, they took their unemployment expectation up from end of year 4.5% to 4.8%. We're at 5.2% now. And their inflation expectations have gone up dramatically from 3.4 to 4.2 for this year, the end of this year on PCE and core PCE, 3.7 versus 3.0. So with those inflation expectations having been taken up, it's natural that more members would say, yeah, I see us raising rates a little sooner. However, if Powell's base case is correct and that the inflation is transitory and largely due to supply chain bottlenecks that will get worked out over time, and the wage inflation will get worked out as labor comes back in supply, now that some of the extended unemployment benefits have rolled off, and childcare is available with more and more kids going back to school. If he's right about those two things, then there would be no reason to raise rates. And he alluded to that if inflation does normalize. So it's going to be a function of inflation, but with them taking inflation expectations up, against Powell's expectation that it's transitory, it was natural to see more members think that there might be a rise next year. If it in fact turns out to be transitory, then you can absolutely erase that.
Well, Powell did indicate today that their inflation target has already been met. So correct me if I'm wrong, but I don't think they need inflation to go much higher for them to take action, correct? His priority is full employment. So there are two things, and the key word that he's consistently used is, while their short-term target has been met, he's always been a proponent of symmetric inflation. So he's willing to let inflation run hot for symmetrically the same amount of time that it ran cold, that it ran 2%, which was, for a considerable amount of time in years, not in months. So provided it doesn't run away from him, he's willing to let it run above 2% for some time in an effort to meet full employment, which is his top priority. And just to put it in context, what does full employment mean? It's like this nebulous concept. Full employment is, if you look at February of 2020, before the pandemic, the unemployment rate was 3.5%. Right now, it's at 5.2. They're expecting it to be at 4.8 by the end of this year. So there's a lot of room there. What about exactly people? There are 8.4 million people unemployed today. February of 2020, right before the pandemic, there were 5.7 million people. So, you're talking close to 3 million people that he still wants to see get employed, so that you don't have any long-term
structural unemployment that we saw for many years following the great financial crisis. And he's willing to avoid that at all costs. And the cost that he's currently paying is the risk of runaway inflation, which he believes won't happen and is in fact transitory. And we'll see. We'll see. But the consensus of the members taking inflation expectations up tells me that there's some disagreement as to whether or not it's fully transitory.
Great. Let's talk about markets and the economy now. I have to bring up Evergrande because that was the headline du jour of the past several trading sessions. Now, the markets, again, have rebounded today, partly on news of the Fed, but actually it was up this morning as well. So do you think markets were sort of just shrugging off any risks from China now? Do you think that that headwind is more or less gone, or do you think that's still maybe a persistent threat?
Yeah, well, Evergrande has been a slow motion train wreck since last July. The stock is down 90% in 14 months. So if anything was telegraphed, it was the demise of Evergrande. The thing to keep in mind here, Asia Markets is a publication. They came out today saying that there was a deal in the works that for the Chinese Communist Party is going to restructure Evergrande into 3 separate entities. And that came out this morning, and the market seemed to like that. Whether it was causal or coincident, we don't know. But if that's the case, what you're going to see is equity holders will probably get hurt. Bond holders of U.S. dollar-denominated bonds will likely get a haircut or hurt. The yuan local denominated bonds are going to get paid, as we saw this morning. The chairman said that they've worked out the payment for the $35.8 million coupon with the locally denominated bonds, but no word on the U.S. denominated bonds. But the whole story here is, number one, the Chinese government is now going to ring fence it. So that's good news. But the real key that everyone has been waiting for, because China was the first to tighten coming out of COVID, and they tightened far too early. And you've seen it in the economic data of late. What they did 6 months ago with tightening has caught up with them, along with their zero COVID policy. And you've seen weaker and weaker numbers. So what a lot of managers are looking for is what's the catalyst where they're going to start to ease. And we saw it with bank lending standards a little bit over the summer. That was positive. The market had the mini rally on that. But what we saw last night, which the market liked, was the China Central Bank injected $14 billion into the system last night. Number one, they kept the 1 and 5 year loan prime rate steady. And now, because of Evergrande and because of this situation and because of the risk to the populace who bought these wealth management yield products and bought apartments through Evergrande, the Chinese government Chinese Bank of China is expected to initiate rate cuts starting next month. And if that's the case, the negative Evergrande is actually going to be a very positive thing for Chinese equities moving forward, if this is the catalyst that gets them to move ahead with easing and accommodative policy, which they've neglected to do over the last 6 months. They've been moving in the other direction. So this negative could turn out to be a tremendous positive as we work through the next couple of days and weeks. Might be a little bumpy, but if it forces them to action for an accommodative easing stance, it'll be very, very good moving forward.
Okay, and finally on U.S. equities, you have an interesting chart I'd like to show the audience here. This is the high yield credit spread, and you've written that valuations are necessarily due for a 10 to 20% correction just because valuations are overstretched. We'll need to see a recession, we'll need to see a yield curve inversion, and these things aren't really popping up on your radar right now. So let's take a look. What can we learn from this chart?
Yeah, I think the big thing is what you've been seeing is 6 banks came out over the past couple of weeks looking for a 10 to 20% correction. I think that's premature. And one of the arguments has been, well, credit conditions are as easy as they've been since 2007. So that's what they view as bad news. There's too much high yield issuance, et cetera, et cetera. But what we find is when credit spreads narrow to this degree after being in such a pronounced extreme situation like we saw last year, like we saw during the great financial crisis when spreads blew out, is once they compress, those conditions last for multiple years. So they go, they blow out, they compress, and then they stay compressed for multiple years. We're only a year in. So I think these accommodative credit conditions should persist like they have in many other cycles, not for 12 months, but more, across the board, sometimes 36 months, 48 months before you get a new tightening. So I think they're premature on the call for 20% correction for sure, because to get a 20% correction, you need a recession. And the only way you're going to get a recession is if you have an inversion of the yield curve where the 210 spread goes pari passu. And we're nowhere near that. We're as steep as we've been in the yield curve in a handful of years, and we're in the early stages of steepening, and then we would still have to start to narrow those spreads before we get anywhere close to an inversion. And again, that's usually a multi-year process that's consistent with high yield credit spreads being narrow the way they are today. So we're at the beginning of that process. We're nowhere near the end, and I think we've got 2, 3, 4 years of runway. That's not to say we can't have these normal garden variety 3 to 5% pullbacks. Maybe next year when the taper starts and the Fed is starting to take the punch bowl away, you'll get your nice 10, 12% correction. That will scare everyone. But to get this 20% that many major banks have been calling for, it's premature, and it would require a recession, and the conditions just aren't there to lead to that type of equity destruction.
So your underlying assumption is that recessions lead to bear markets in the order of 15 to 20% or perhaps even greater. So let's talk about that. Let's talk about a possible recession. Well, the Fed is projecting lower GDP growth. I mean, lower is relative because they're projecting 5.9 down from 7%, which is, higher than the historic average anyway. So is it possible then that GDP could contract all the way down to zero and perhaps negative in the foreseeable future, given the Delta variant, given any other market risk? I know you're smiling already. So anyway, I'll get your thoughts.
Yeah, I mean, look, their projections for this year have come down a little bit, 5.9% due to Delta, but we're still above trend next year. They have us at 3.8%, which is well above trend. And you got to consider, with the money supply expansion approaching $5 trillion plus, you're going to get another $1 to $3 trillion of infrastructure social spending when you actually don't need it. You do need the infrastructure, you don't need the other. But leaving that aside, it's coming, whether you want it or not, it's coming, and that's going to be stimulative. It's really, the world is awash in liquidity. That is going to continue. You've got corporate buyback announcements, $760 billion and rising. You have the liquidity we talked about. Earnings estimates continue to go up despite short term. You've been hearing about margins due to labor and supply chain, but these things are going to get worked through as we get a greater supply of labor and you work through the supply chain. And then you've got another, 4.5 trillion in money markets is fine, but compared to what? Pre-pandemic, there was only 3 trillion in money market funds. So another $1.5 trillion sitting in money markets funds, losing purchasing power on a daily basis due to inflation. That money's going to have to move into risk assets, or they're going to lose their purchasing power. So there's just an insane amount of liquidity, and the cycle is just starting. We're 1 year in, not just ending. Just because we've had a big move in equities doesn't mean the economic cycle is over.
I guess we'll need another global lockdown on the scale of March 2020 to precipitate a major recession, a contraction of the economy. I mean, we had one, albeit for a short window of time, but it happened. So how likely is another global shutdown? And I'll
zero. I literally think it's zero probability. I think people just won't have it. You've got 6 billion vaccines have been distributed globally. Most people, if they've had a vaccine, even if they get COVID again, they're probably not going to have a hospital visit. So that's a good thing. And I think people just want to get out and about. They put their masks on. They do what they have to do, but by and large, a lockdown.
What I've learned last year is it's not what the people want, Thomas. It's what the government wants.
So that's fair. That's fair.
You've got to read into what the government is planning to do. All right, Thomas. I know we've had enough of your time already. Thank you very much for your thoughts. Excellent insights, and we'll speak more about your investments next time. Thank you for your thoughts.
Appreciate it, David.
And thank you for watching Kitco News. Stay tuned for more, and don't forget to subscribe on YouTube.